Hello and welcome back to the Geordie Pig Investor channel. Today we're going to look, is BP PLC stock a buy right now? What is British Petroleum PLC, ticker symbol BP? Well, BP operates as an integrated oil and gas company. It engages in the global energy business with operations in Europe, North and South America, Australasia, Asia and Africa. The firm delivers heat, light and mobility products and services to customers around the world. The firm's main segments include upstream and downstream. Interestingly, the company also owns and operates approximately 3,055 retail service stations in Russia and abroad. Key stats about BP: they're based in the UK. They are in the energy industry. They have a market cap of 83 billion. They went public in 1954, have over 65,000 employees, have a current dividend growth streak of 2 years, but a 3-year dividend growth rate of over 10% and a rather big dividend yield at over 5%. Over the last year, BP is down over 9%, and we're going to have a little look and dive further into this today and see if it is at a good trading price to potentially add this stock to your portfolio. BP's earnings call and fundamental analysis. At the start of 2024, they have shown promising signs as they delivered resilient financial performance despite some unplanned outage. In their first quarter, their adjusted EBITDA was 10.3 billion and underlying earnings were 2.7 billion, which shows great progress. In their earnings call, they also mentioned that operating cash flow was 7.4 billion in the quarter, and they continue to make good strategic progress across the board. They are also removing complexity across the company, and they announced a target to deliver at least 2 billion of cash cost savings by the end of 2026. Fundamental analysis. BP have a positive free cash flow of 14.6 billion. They have exceptional 3-year revenue growth at 23%. They have a positive operating income at 23.7 billion, positive gross profit at 58.4 billion, and a positive net income at 9.3 billion. They have a positive ROIC at 8%, very low debt to equity at 0.81, very solid long-term and short-term solvency. However, they have a low Altman Z-score at 1.21 and positive net debt at 24.7 billion. Overall though, I think these are very promising signs for BP. Let's have a little further dive into their free cash flow. What is free cash flow? Free cash flow is the money a company has left over after it pays for all of its expenses and any investments it needs to make to keep the company running smoothly. Free cash flow has a massive impact on the direction a company may be heading. We can see from this graph that BP has been steadily increasing its cash flow from 2017 and has not had negative free cash flow since then. It took a slight dip in 2020 during COVID, as did almost all companies in the sector, as they were heavily affected with the prices of oil dropping so drastically. However, it has since been on a nice recovery and hit all-time free cash flow highs in 2023. They are comfortable with their free cash flow and have been looking to expand the business with many different ventures. Overall, I believe it's in a very strong position and has a fairly low free cash flow payout ratio at only 51%. This means they have great scope to continue rewarding shareholders with dividend hikes and potential share buybacks. Very, very exciting signs from BP, and just something to think about when we move on and now looking at the discounted cash flow valuation. The DCF valuation is a method that estimates the current value of a company based on projected future cash flows adjusted for the time value of money. The DCF valuation process calculates the present value of a company's forecasted cash flow based on selected operating models. A reminder that BP's price is currently 433 GBX. When plugging in a discounted rate of 8.25% and a terminal growth rate of negative 2.6%, BP's DCF value was a worst case of 551 GBX, which is a 21% undervaluation. When I plugged in a 7.9% discounted rate with a 0% terminal growth, BP was valued at 1,027 GBX, which is a 58% undervaluation. And when I plugged in a discounted rate of 7.5% with a terminal growth rate of plus 2.6%, BP was massively undervalued at 84%, being valued at 2,692 GBX. Alongside the DCF valuation, I do another valuation called the relative valuation. This is a method used to value a company by comparing it to other competitors based on certain metrics. The metrics that I personally use are EV to revenue, EV to EBITDA, and the PE ratios. When using these metrics on the worst case scenario, BP was valued at 730 GBX, which was an undervaluation of 41%. The base case scenario, came out of being undervalued at 52%, being 905 GBX. And the best case scenario was undervalued at 66%, being worth 1,292 GBX. From these, we can get something called the intrinsic value, which is combining the two valuations together and then dividing by 2 to get an average of the two. So just a reminder that BP's price is currently 433 GBX, also known as £4.33. And when combining the two methods together on the worst case scenario, we see that BP would be worth 640 GBX. On the average case would be worth 966 GBX. And on the best case would be worth 1,993 GBX, which is quite considerably higher than what it's valued at right now. Not only do I look at the intrinsic value, but I like to do one other method to really solidify my different valuations, and that is the Wall Street estimates. Wall Street estimates are an average estimation of a public company's quarterly earnings and revenues that lead to a valuation of that company. These numbers are forecasted by a company-specific analyst who provides research on that particular company and therefore comes up with what they believe is an accurate valuation. For companies the size of BP, there are going to be multiple analysts and it's going to be a lot more likely to be accurate. On the worst case scenario, the Wall Street estimates estimate that over the next 1 year, they are likely to have a 16% upside, being worth 505 GBX. Average case scenario being up 37% and having a value of 592 GBX. And on the best case scenario, having an 82% upside, being worth 787 GBX. So from this, we can then now add the three valuations together and come up with our worst, average and best case scenarios. On the worst case scenario, when adding my three valuations together, BP would be worth £5.95. And if I use a 10% margin of safety on this price, I'd be looking to buy it around about £5.35. And with a 20% margin of safety on this price, I'd be looking to buy it £4.75. On my average case, it came out as being worth £8.41. So with a 10% margin of safety on the average case price, I'd be looking to buy it £7.57. And with a 20% margin of safety on the average case price, you'd be looking to buy it £6.73. And with the best case scenario, we can see it was valued at £15.90. So with a 10% margin of safety, you'd be looking to buy it at £14.31. And with a 20% margin of safety, you'd be looking to buy it £12.72. What does this mean for BP? Well, the conclusion that I have for BP is that I think it is one of the most underrated companies on the market right now. The only concern I really have about the company is that I know how volatile the gas industry can be, and it has a record for slashing its dividend payments. But if you're a long-term investor like myself and are looking to buy stocks to hold for 10 plus years, then right now I believe this is a no-brainer. They still pay a very healthy dividend yield at over 5% and still have a very good 3-year dividend growth rate as well. On top of that, their FCF ratio is fairly low, and although the oil industry may not be the most lucrative in 30 to 40 years' time, you can still reap the rewards over the next 10, 15, 20 years. So for me, at this current price, it's definitely looking like a strong buy. What do you think about the company? Is it one that you've already got in your portfolio or one that you're looking to add? I hope you enjoyed today's video. Please let me know in the comment section down below other stocks that you'd like to see analysis on. Thanks for watching. Please like and subscribe. This is the Geordie Pig Investor, over and out.